Morning, everyone. Welcome to the December investment meeting, and I will turn it over to Madam Chair for the introductions.
Good morning, everyone. Rosemary DeBellis, representing Police Commissioner Kelly.
Dan Torelli from the PBA.
Joe Alejandro, PBA. Chris McGrath, PBA.
Lou Turco, LBA.
Roy Richter, CEA.
Bill McNeely, DEA.
Bob North, Actuary.
David Jeter, Office of the Control.
Yvonne Nelson, Controller's Office.
Martin Gans, Controller's Office.
Seema Hingorani, Controller's Office.
John Liu, Controller's Office.
Thad McTeague, Controller's Office.
Janice Emery, Mayor's Office, and I also have the proxy for the Commissioner of Finance today.
Bob Sanskisted, Pension Fund.
John Dawson, Controller's Office. Alex Deviani, Controller's Office.
Paul J. Racy, Pension Fund.
Good Boys Pension Fund. Chris Bob, Controller's Office.
Liz Caldas, Controller's Office.
David Morris, Controller's Office.
Ready?
Everybody here?
I think so.
All right. I'll turn it over to the Controller's Office.
Great. So I'd like to turn it over to Controller Liu. I think we'd like to share a few remarks with you.
Thank you, Thad, and thank you, Madam Chair, for this indulgence. It has been a privilege. I feel like I was just here yesterday. And in fact, it's actually been almost 4 years since I last attended the Police Pension Board meeting. I did want to take this opportunity to come back once again just to say thank you. Thank you for the great work that this board does. Thanks to my staff as well for making sure that things run smoothly, and thanks to the leadership of this board. I think over the past 4 years we have a lot to be proud of. We have raised the bars on transparency. We have really modernized parts of the pension investment process, and I think the results speak for themselves. If you look at the past 4 fiscal years, we have a cumulative investment return, not necessarily specific to the pension fund, the police fund, but across all 5 funds. But certainly the police fund is not going to be that different overall. We're up 58% for the past 4 fiscal years. That includes 6 months predating my tenure. So if you count from January 2010, Seema tells me that we are now at $150 billion, which gives us a cumulative return of 50%. And we're crossing every joint in our bodies to make sure that that holds up over the next month. But it really has been a privilege to work with all of you and to serve as New York City Controller. On a personal note, I'm far beyond anything I imagined would happen in my lifetime. Growing up here in New York City as an immigrant, I never expected or imagined that I or even someone like me could ever run for office, let alone get elected New York City Controller and this year be a candidate for something else. It's an awesome city. It's a city that is in many ways entrusted to the members of this police pension fund. And we have to continue to do everything we can to not only take care of the members, but also of course, all the beneficiaries and unfortunately many of the survivors as well. I think some of you have also seen me at the Police and Fire Line of Service Widows Association, which is of course a very sad organization to be a part of, but nonetheless one that deserves our support, our ongoing support. So in any event, I want to thank Seema for assuming the role of Chief Investment Officer. She had some pretty big shoes to fill after Larry he abandoned us. Larry did very well for us for almost the entire 4 years, and I certainly am thankful to him as well. And I know that my staff has enjoyed working with all the trustees here. So once again, thank you. Keep going, and better things yet to come. Thanks so much.
And John, you know what? I just wanted to say, on behalf of the CEA, there's no greater measure of a stewardship than success. So you can be very proud of the success of the investment rate of return that we've had with your staff and your team that you've put together. And also, I just want to thank you for being a voice that we can rely on to speak up for the members, my members, and other members of the Police Pension Fund when benefits that they've worked hard for and purchased were under threat by a different administration. And I really appreciate you being one of the voices that stood up in defense of them.
Thank you. Thank you. All right.
Thank you.
Rosemary,
Thank you for coming today, and we wish you all the best.
Thank you.
It's been a pleasure.
I know you're an actuary, so I assume you're going to keep tabs on the pension fund.
I'll be keeping an eye on it, yes. Yes.
Close watch.
Yeah, but I'll keep my thoughts to myself. How about that?
For at least a year.
Sometimes we wish the actuary kept his thoughts to himself.
So may I be excused, Rosemary?
Yes, of
Thank you
course.
very much.
Thank you for coming this morning.
Have a wonderful meeting.
Thank you.
Thank you.
So our first item in the public agenda today is the quarterly reviews. So I'll turn that over to Seema.
Thanks, Dad.
One extra copy? Anyone need copies? David wants it. Oh, wait.
Hold on, I was told, Barry, that they had their night line on, so he said we can call him now if you want. Sure. So I'll dial, hopefully he'll pick up.
Yes.
This is like a lifeline, right?
Yeah, Barry?
Yeah.
Hello, Barry Dennis, please. Barry? Thank you. You gotta do it for yourself 10,000 times.
Hi, this is Barry.
Barry, it's Joe Alejandro at the pension fund.
Oh, thanks for calling back.
Okay. All right, so the meeting's about to begin, so we have Seema.
Thanks, Joe. Okay, so we're going to go through the quarterly for September, and I'll ask Martin to start us off.
Yes, so before we go directly to the returns, just want to go over what happened in the September quarter, and we are referring to the September quarter, which is the first full quarter in fiscal year 2014. And the September quarter was a really good quarter. It comes on the heels of very shaky markets at the end of June due to concerns about tapering and the Fed's potential stopping of their bond buying purchases. But in the September quarter, starting in July, the markets recognize that the bond buying program is not imminently going to stop. And so interest rates calm down, but moreover, U.S. equities and other equities around the world did extraordinarily well. For instance, in the U.S. equity market, as represented by the Russell 3000, results were over 6% just for the quarter, and for the one-year numbers, now more than 20%. EFA, developed markets, non-U.S., was up over 11% just for the quarter, and up over 23% for the year. And even emerging markets, which had trailed and lagged and had negative returns for the prior quarters this calendar year, saw more than a 5% increase in fixed income. Government bonds obviously were roughly flat, investment grade roughly flat, slightly positive. But the riskier assets and more equity-sensitive assets, such as high yield and convertible bonds, did very, very well. So if you turn to page 8, a couple of things I want to point out. And the very first thing I want to point out is on the very top left of your page, in red, you'll see that the market value for the first time ever for a quarter end is over $30 billion, so congratulations on that. 30.4 for September. And in just a moment, Seema is going to have some information about October, which was another good month, and November, so the number gets higher. But for this particular quarter, on the left, you'll see the bars, and for one quarter, a 5.28% return is an extraordinarily strong return, and that was also well ahead of the policy benchmark of 4.5%. The one-year number, you see, very strong on both an absolute and relative basis at 13.19. Three-year number was behind the benchmark, but returned over 10%, nearly 10.5%, and 5 years and 10 years are either above or around 8%. The next two pages show the asset allocation. The second page on page 10, you saw this last month, and it shows where we are in the bottom versus the policies, the adjusted policies. And this is similar. We'll go through October because we have some updates on that. But it's similarly situated as we were before. Overweight on the left, as you see in green, in U.S. equities, and underweight in the middle in blue and in purple in core fixed income and in tips. As you'll see in a moment, those decisions added to the portfolio. And in fact, on the next page, on page 11, for the quarter's attribution, the return of 528 was significantly ahead of the overall benchmark, which was 4.5. And both managers doing well and decisions on where to be overweight and underweight helped. So the major decisions were being overweight U.S. equity and underweight core plus 5 in tips, as I showed you on the previous page. All of those decisions helped. Any cash that was held hurt, because in a 5% quarter, any cash earning effectively zero would have hurt. But the overall effect was a positive 24 basis points. The management effect, most of that is attributed to, and that's about 50 basis points, to U.S. equity, and Stephen's going to go through that in a moment. For the year, on the next page, the allocation effect again was very strong because of the strong U.S. equity market and the overweight to that, and the similar underweight to core plus 5 and tips, which underperformed and therefore helped. For the management effect, U.S. equities did very well, but that was mostly offset by an underperformance in private equity. And for the three-year number, the underperformance and the allocation effect was the cash at the time, and the management effect was negative, mostly from private equity. Underperformance versus its benchmark, and you'll see on the next two pages summaries of the major asset classes. And before I turn it over to Seema, I want to draw your attention to page 17. And this is how police did versus other large public funds. If you look at the left for the one quarter, the 528, near the blue dot, placed you in the 38th percentile, which is the second quartile. For the 1 year period, that's the fourth column from the left. 1319th placed you also in the second quartile of the 43rd percentile. 3 years right at the median, and 4 and 5 years also good. In fact, 5 years in the 20th percentile. So good numbers all the way around on an absolute basis, and in most cases on a relative basis as well. And as I said, we're now, for police, over $30 billion. And I'm going to turn it over to Seema.
Thanks, Martin. So if you turn to page 20, we'll start with the U.S. equity returns for police. And as you can see here, it's about 41% of the total funds. And the numbers are quite good. So just even on an absolute basis, if you look in the quarter, as Martin mentioned, the Russell 3000 up over 6%. Our managers and our allocation actually helped us do a lot better, not only in the quarter but also in the trailing 12 months. You might remember our overweight to small cap, our overweight to mid cap, and our underweight to large cap versus the Russell 3000 helped us a lot. And our active managers actually did quite well. And just as an example, I'll run through some of these numbers with you. In the third quarter, ending September this year, small cap on an absolute basis was up 10%. Police's small cap was up 12.1%. So really good outperformance there. And small did much better than large. Mid cap was up close to 8% on an absolute basis. Police's mid cap was up about 30 basis points more than that. In large cap being up about 6%, police's large cap was up 11%. So overall, the quarter and the trailing 12 months both on the allocation basis and on the active manager basis. Police did very well. If you turn to the next page, this just goes through some more of the details behind the U.S. allocation and how it's split up. And as you can see from the pie chart, it's split up a little bit more than it has historically because now we've been able to carve up the Russell 3000 into its component parts, which actually will help us longer term, we think. But in any case, generally, police is over 80% passive in U.S. And again, if you just look at these three columns below that we tend to talk about, the index return, the actual return, and the difference column, you can see there again the U.S. markets is measured by the Russell 3000 up over 6%. The Russell 2000, which is small cap, is up over 10%. And then in the difference column, just referring to what I was mentioning earlier, the active managers in the portfolio had done well for police. If you then turn to page 28, we'll go through the international portfolio. And here, as you can see, it's about 16% of the total funds, and that's both IFA and emerging markets. And in the pie chart on the left there, you can see it's kind of just the opposite to the U.S., where we're over 80% active and the rest passive. And then again, these three columns, I'll point you to the index return, the actual return, and the difference column. As Martin mentioned earlier, you can see the IFA passive, if you scroll down a few rows, up 11.5%, so much stronger than the U.S. markets. And then scroll down a little bit more to the passive VM, up close to 6%, so about in line with what the U.S. did. But if you look at IFA small cap, which you might remember in this last search that we completed for IFA, we added a small cap allocation because we thought it would be a nice diversifier as well as provide some good risk-adjusted returns for the portfolio. That index was up close to 15%. So that helped us because we now have exposure to that part of the market. So if you turn to the next page, there's some IFA detail. So you can see in the trailing 3 months, there's a bunch of bars there, but basically the purple bar is the total police IFA portfolio. The yellow bar is the index. And the blue bar is your active part of the IFA portfolio. And you can see here in the trailing 3 months, police nicely outperformed a little over 100 basis points versus the index. So some of our IFA managers are doing well for us. And you can see in the trailing 12-month period, the numbers are over 20%. So good performance out of IFA. If you then turn to page 36, it's emerging markets. And here, I mean, emerging markets we've talked about before has had a tougher time versus the IFA markets and the U.S. markets. But nonetheless, in the quarter, they did quite well, up close to 6%. And our manager's just doing a little bit better, but roughly in line. And then you look out into the trailing 12-month period, and the numbers go down, so close to 2% in terms of absolute returns. But our managers are still outperforming, as you can see in the purple bar versus the yellow bar, by about 30 basis points. If you then turn to page 38, this is the hedge fund portfolio as of 9/30/2013. And so in the trailing 3 months, where the blue bar, we're behind both benchmarks. And then in the trailing 12, we're now behind. As you might remember, a few of the strategies that are in our portfolio have underperformed relative to the strategies we're trying to move more into. And so we've been underweight those strategies that have been more equity sensitive. And so that's been the reason for the underperformance in the short term. But as you know, we've been working hard to get the hedge fund portfolio more into balance and to have more of that equity exposure.
Given what you just said, what's the difference between the strategies that we have currently and the ones that we want to move into? What's the performance difference?
So, as an example, global macro, where we have exposure to a couple managers there, those managers are up on average, and our guys are up about 1.5% for the year. Whereas the event-driven managers, where we're moving into, we have one or two, but just recently, on average are up 10-11% for the year. So yeah, we We, in talking with Axia, and talking to the boards, we were anticipating that equity-sensitive strategies would do better in this market, given that the U.S. equity markets are up close to 30%. But just for various reasons, the funds weren't quite right for us as we were making our way through the group. And we were able to add a couple good managers, but kind of mid-year, so it didn't help us as much as it could have had we done it earlier. But that's where we're headed, to be more balanced. If there aren't any other questions, I'll turn it back to Martin.
So on if you turn to page 40, shows the overall allocation of fixed income, lots of slices of the pie. The largest, obviously in blue, is the investment grade core fixed income, and that is further broken down on page 41 for the three sectors, and draw your attention, as I have for the last several quarters, to the overweight column. And we've been underweight treasuries and overweight spread sector. It shows here we're underweight investment grade credit. Part of that is that there's been more issuance in investment grade credit, and also, as Seema will talk about later, we added some money to the investment grade credit sector, so we're now overweight that. But if you look at the either the index or actual returns, you'll see that the government treasury agency sector had negative returns because rates went up in the quarter, and the spread sectors did well, and therefore the allocation to be underweight governments helped within the Core Plus 5. And the difference column shows that the managers themselves outperformed. Of the 15 managers, 12 outperformed, and of the 3 that didn't, 2 of the 3 were very close to the benchmark. So the program has done very well. Showing the results on page 42 for the quarter, I cannot compete with Seema's equity returns, but they are positive, 0.83% for core fixed income. That's at 20 basis points ahead of the benchmark. And for the year, for the 1 year number, it is negative, again, because interest rates rose during that period in June. And the results were minus 159. That is 73 basis points ahead of the benchmark, but nevertheless still a negative return. So the positive performance of the managers versus the benchmark and the allocation effect does help, certainly when you have low or negative returns. 3-year number is modest, but also ahead of the benchmark, and the returns are ahead of the benchmark for the longer periods of time as well. Those returns are coming down as well to the 5 and 6% range. TIPS, because they're treasuries and have longer durations, had lower returns for the overall 1 year period. They had similar returns for the quarter. All 3 managers outperformed, returning 83 basis points ahead of the benchmark of 70. 1 year, while negative, minus 584, was ahead of the benchmark. The 3-year number was approximately 4%, just behind by a few basis points of the benchmark. And the TIPS composite is 3% of the total fund. High yield, on page 44, lived up to its name. For the quarter on the left, you'll see the returns in blue are 235, and that's 47 basis points ahead. And this is because our aggressive managers did very well in an aggressive environment. And for the 1 year number, the results were very good, 764, and that's well over 175 basis points ahead of the benchmark. And part of that had to do with, if you remember, we did our search, culled some of the underperforming managers, replaced them with managers we had more confidence in, and those managers have done well, and certainly removing the underperforming managers helped. 3-year number, 5-year number, 10-year, 15-year, all ahead, except for the 3-year number, by well over 100 basis points. In fact, the 10-year number is up 8.5%, and the 15-year number of 7.5%. High yield has done very well. The program's done very well on top of that versus the benchmark. Convertible bonds on page 45. In blue, you see the returns, which are high because it has higher equity sensitivity of a little over 4.5%, but compared to the yellow line of the convertibles benchmark, it was well behind the convertibles benchmark. But I want to draw your attention to that purple or brown line. Someone help me with that. That's the maroon. That's the second. Thank you. That's the secondary benchmark, and that is the benchmark that's the weighted average of the 2 managers. So each of the 2 managers actually did okay versus their benchmarks, or close to their benchmarks and ultimately together outperformed, but underperformed the overall convertibles index, which is not unusual in a bull market. And the reason for that, as we've talked about before, in a bull market in convertibles indexes, the convertibles index providers have not changed their methodologies, which is if a bond has a 2% weight and the underlying stock goes up, as has happened in the market, of course, because convertible bonds go up as the stock price goes up, the weight in the index for those stocks can go from 2% to 10% fairly quickly. And managers will not own 10% of a stock for diversification reasons, but that can cause underperformance. Over a market cycle, it should be much better, and it does get better as you see the 5-year number. The 5.5-year number since inception would actually show outperformance because there was the 2008 downturn. But the blue versus the maroon is the actual underlying managers versus their weighted average of their individual benchmarks. But over a market cycle, they should all converge. And as you know, we also culled a manager, an underperforming manager from the program, so we expect that that will help going forward as well. Opportunistic fixed income on page 46 in this environment should have done well, and in fact did do well, returning over 4%, well ahead of both the 10% return as well as the global high yield benchmark plus 3% for the quarter, and high teens for the 1-year period and mid-teens for the 3- and 5-year period. This is a program that's getting past an inflection point of having more strategic mandates on board, and so we should have more of the returns influenced by those strategic mandates going forward. And unless there are any questions, I'm going to turn it over to David for discussion of ETIs.
Thank you. Good morning. Turning to page 13 of the public agenda, the returns.
They're in the regular.
In the regular portfolio. This quarter, the police ETI portfolio outperformed its custom benchmark by 10 basis points, and PPR performed quite well as well, beating its benchmark. In the third quarter, turning to page 7 and 8 of the book, the police fund purchased $3.2 million of loans under the PPAR program that will create or preserve 279 units. We also made commitments through CPC for another $4.2 million that will cover 233 units, and an additional $0.8 million with LIF covering 53 units. The market value of the PPAR portfolio is currently $114.7 million. And we made one investment that we're very excited about in an ambulatory care unit at a local hospital that is expected to create in total 5,200 jobs, and all of those jobs will be union labor. Are there any questions?
And so this is the quarterly report from private equity ending June 30th, 2013, so the second quarter. And you'll see that for a number of managers in your portfolio, you have a total of 110, which altogether is about 165 funds. Your total capital committed is at $4.1 billion. Total capital contributed that you've given out is $2.6 billion, and the capital you've gotten back is $1.6 billion. The market value of the capital that's on the ground right now is valued at $1.9 billion, which would give you a total value of $3.5 billion. And then you'll see that the if you look further down on that table, the total value multiple that you've earned on that last quarter was 1.35 times, which is growing nicely from the previous quarter and the year before. And then your IRR is at 9.8%. Now, if you look at the next page with the bar charts, that puts you against, so you can chart yourself against the benchmarks.
And you'll see that you underperformed slightly against the Russell 3000 plus 300 basis points, but then significantly overperformed against the Thompson 1 median IRR, which came in at 4.1%. So if you'll turn to page 29, you'll see the relationships and the commitments that we made in that June 30th in the second quarter of 2013. And you'll see that the table down there that you have 8 new commitments that were made, 3 of them that were into the core larger private equity portfolios, and then 5 of them that were done into the smaller emerging manager program. You'll see the names for the emerging manager programs were the Incline Equity 3, Altus Health 3, Capital Partners 2, and then Gray Mountain 3. And then for the core relationships were Apollo 8, CVC 6, and Olympus 6. And they all total $244.9 million. And then subsequent to the quarter end, you had 2 more closings, and these both were from the Emerging Manager Program, Vista Foundation 2, and FT Ventures 4, and that came out to a total of $10 million. So if you turn to page 32, you'll see how the different strategies are performing for you. And the table below, at the bottom of the sheet, you'll see that the top 4 performers for you, starting number 1 with your secondaries portfolio that came in at an IRR of 16.8%, performing very strongly. Again, these are names of both existing and new relationships that have come in over the past couple of years. And then a lot of this is led by Landmark, AXA, and Lexington. And one point to mention here is that AXA, which has been around since, we invested in them in 2012, and they've already delivered 30% IRR for you, so it's a very strong fund. And then Lexington is also an 18% IRR. So both of them are coming back in January, so you may be seeing them again for the next fund. Then after that, the next stronger performing strategy is growth equity that came in at 16.6% IRR, and that's all led by some great relationships that we have there, in particular Vista, which has already been doing a great performance, and we've invested in a couple of their funds over the course of this past year, so it's very exciting. Came in third with Special Situations, which came in at 12.7% IRR, and that's led by great name funds that we have like Ares that have been an existing relationship for you all for a while, and then new relationships like Platinum. That's we were in a call recently with them, and they're performing terrifically, and that's 2012 funds, so they're terrific. Then the last again is buyout coming in at 11.4%, and what's leading the pack there in the performance there is the larger buyouts, the names like Carlyle and Apollo and CVC that are performing really, really well for you over the past few years. Great relationships. So if you turn to page 37, it's the last piece that I'll mention. One of the more important pages as well, because it shows the cash flows, the quarterly cash flows coming in and out of your portfolio. It shows it over the past few quarters. The bar charts at the top, so the cash coming back to you, the distributions at the bottom are your contributions, and then that line shows where your the net cash flow is. So you'll see that your total distributions for the quarter end was $102 million, and then below clearly the contributions at about $50 million. But what's really important to show here is that it's when you compare the second quarter of 2012 and clearly 2011 doing much, much better, so nice progress up. And then you'll see when the fourth quarter comes around again, when we have to reflect this quarter, the next couple of quarterly reports in the future, you'll see we'll have a nice distribution line coming right back up. So all trending in the positive direction, and that is the second quarter quarterly report for private equity.
Great. So moving on to real estate, so in the same book, page 47, unfortunately there's a top bar that obscures the page numbers, so I'm going to refer to the page numbers at the bottom of this report. So this page 47 actually has a page 1 on the bottom, and I'm going to be referring to those numbers at the bottom. So just to review the highlights of the real estate performance for the second quarter for police. We've talked about market conditions, we've talked about the real estate recovery since '09 and the various stops and starts that we've experienced since that time. But right now there's been improved investor sentiment, not only in the U.S. but across the globe as it relates to real estate. And there is significant traction such that most people think that there is a recovery underway, with the U.S. Leading other parts of the world in that real estate recovery. And one of the signals that we look to that is the number of transactions in commercial real estate. And for this particular quarter, the transaction activity was about $120 billion on a year-over-year basis. That's an increase of 10% of activity. That's great progress for real estate. And the projected overall transaction volume in real estate for the year may even hit $500 billion. So in terms of what exactly investors are deploying their capital in, early on in earlier presentations, we talked about the fact that most investors were looking for properties in gateway cities, looking for core real estate. Well, those yields have compressed so much that investors are actually moving up the risk curve now. They're kind of looking at opportunities outside of those gateway cities into secondary markets, and also they're looking for more value-add activities where they can fix either broken capital structures or the real estate itself to make the yield that they're looking for. So under these conditions, we have about 32 managers for the police portfolio, and these managers are hard at work. They're either buying because we've recently committed to them, or perhaps they're more mature holdings that we have, and they're harvesting in this environment. But just to give you some particulars about your portfolio over on the left side of this same page, just to recap the fact that we have a 6% allocation to real assets at this particular time. We are 3.3% funded in real estate, and the market value right now is $965 million. We have commitments that we have yet to fund of about $373 million, and our total exposure to real estate is $1.3 billion through about 45 investments, and as I mentioned, with about 32 managers. In terms of how the portfolio performed for second quarter, it was 4%, 10 basis points above the real estate benchmark. And over down to the right, you'll see a graph. Unfortunately, the solid line is the police portfolio. So next time that I report on this, I'll make sure that I choose a color so that you can see what the benchmark looks like. So just trust me on this. So in terms of your portfolio performance over various periods, the post-recovery returns have been strong. The police portfolio has outpaced this benchmark, both for the quarter, for the 1 year, and in the 3 year. Ran into some headwinds since inception, but we continue to move in the right direction. Our portfolio is comprised of core and non-core investments. Our benchmark is IC plus 100 on a net basis. It's a premium attached to that to recognize the fact that we have some non-core portfolio investments. And in terms of the other ways that we manage risk, there's regional diversification, investment diversification, manager diversification, leverage, which of course everyone is very sensitive to. Right now the portfolio has a leverage level of 43%, well below the cap of 65%. In terms of investment activity during that quarter, there was a $30 million commitment to an industrial fund, KTR, which has since closed. We also closed MS for $30 million in that same quarter. Subsequent to the quarter, we closed on 3 additional real estate deals, Divco West, Blackstone European 4, for a total of $175 million. So as we kind of move on to the next page, which is at the bottom, it says page number 2. We look at portfolio construction, and you'll see that the program guideline indicates that we should be 60-40 in core plus, or 60-40 in non-core. You'll see for this particular quarter, what we are is 33% core plus and 67% non-core. And if you recall, tactically, for the past couple of years, we've been overweighting non-core to take advantage of some of the opportunities in this recovery. And so we no longer have that overweight, but it'll probably take some time for things to normalize back to that 40-60. Just wanted to point that out. And the next page, at the bottom it says page 3, for you all that like detail, it kind of breaks out performance into which part of the portfolio was performing for you. So in terms of the core plus part of the portfolio, where you have 13 managers, that part of the portfolio delivered a return of 3.3% on a net basis, and the driver of that was the Prologis and Heitman funds. On the non-core side, you have about 28 managers, and that part of the portfolio delivered a very strong 4.5% net return, and that primarily was driven by Divco West 3, one of the reasons why we decided to do a re-up with that manager. And the following page, on page 4, it gets a little granular in terms of who contributed to that 4% net return that we see. So it's a great visual, though. So on the right side, you'll see the bars on the right side and the names identify the managers that drove the return, and the, at the bottom, naturally, are the ones that detracted from the return. But just to point out, drivers of the return on a quarterly basis, and we're a long-term investor. I mean, this is really just a visual exercise to kind of give you a sense of what's happening quarter by quarter. But we're in this asset class for the long haul. This is just a quarterly snapshot, but just to kind of tell you who's driving the return, again, we see Divco West, Blackstone, and Angelo Gordon. So, in the following page, we talked about how we manage risk, and one of the ways we do that is through property type diversification and also by geography. So that kind of lays that out for you. There's some market detail here, and in the following pages, there's some compliance reports, and also if you look on page 10, there's other snapshots of that manager attribution for the 1 year and for the 3-year period that you can take a look at your leisure. And that concludes the report for the real estate portfolio for second quarter. Thank you.
So unless there are any questions on the quarterlies, we'll move into a quick review of the October monthly.
Okay, thanks. So everybody has color book? Okay, so thought we'd just go through a little bit of what's been going on in November, now that it's early December. So the stock market in the U.S. again was up. The developed markets again was positive. Emerging markets slipped into the negative territory. As we've been hearing in the markets about, well, is the Fed going to start tapering their bond buying program or not, and when is it going to happen? And so it was a bumpy ride in November, but we ended slightly up, which is a good thing. So the European Central Bank surprised on the upside, I guess, in terms of the markets, with a rate cut of 25 basis points, and then you had the Fed going back and forth with what they're going to do, and the incoming Fed chairman, Janet Yellen, going back and forth with what she may or may not do. So going into December, we've already seen some bumpiness as well, but nonetheless, November, as I'll show you, we ended up, even throughout all of that. So if you would turn to page 34. This is a snapshot of what it looked like in October, and then I'll run through the November numbers with you. So if you see, scroll down a few rows to the Russell 3000, the U.S. markets being up over 4% in October. The EFA markets being up over 3% in October. The emerging markets up close to 5%. Go down a bit more, the Core Plus 5 up over 1%. The high yield index up close to 2.5%. TIPS up about 55 basis points, and converts up over 2%. So a very strong month of October. November is strong as well, so we'll go through the same numbers here in November. The Russell 3000 up close to 3%. The IFA markets up about 1%. The emerging markets down about 1.5%. Corp plus 5 down about 65 basis points. High yield up 32 basis points. Tips down 1.2%, and converts up close to 2%. So you net all that out, and we think we get to sort of an up 1% number for us for the month of November. So if you then turn to page 30, this is our asset allocation and how we're set up for police. And as Martin mentioned earlier, in November what we did was we sold down some U.S. equities, taking advantage of the really strong markets, and now we're back within the range for equities. So this green bar to the left now is further back into the range, and as Martin also mentioned, we added to Core Plus 5 with that money, and we added that in an investment grade. So now this blue bar here to the right, we're now back within the range there as well. If you then turn to page 35, this goes through the contribution to return in the month of October. So the far left bar, the 1 month number for the fund, up a little over 2.5%, so it's a great month. And if you scroll down over a few bars to the fiscal year to date, so the total fund through October is up close to 8%, which is a great number. And now, as we talked about in November, if you add in about another 1% gain, the police portfolio now, fiscal year to date, is up nearly 9%. So it's a great result so far. If you turn to page 27, it shows the 12-month market values for police. And over that time period, police's portfolio is up nearly $5 billion, which is a big number. And so as of the end of October, we're up over $31 billion. I can tell you as of November 26th, just a few days ago, the police portfolio is now at $31.5 billion. So it's great, great result.
So the doomsay is out there, out the sky's falling. We can allay their fears, right? All is well with the world. We're back into the black, so to say.
Yeah, I certainly hope so.
As I've said before, we were long-term investors. We'll ride out the bad, times in the economy. We'll go forward. I believe, Bob, our 9% beats the assumption rate of the new one of 7%. If I'm correct here.
Anything above 7%
is good,
but
right?
The long term is what matters.
But I think we were 9% before, so we're kind of back on line, right? So that's good. Okay.
It is
Okay.
good. So if you look at the next page, 28, this I guess gets to both your points. Over the 10-year period.
Wow.
Look at that.
Need more paper for that.
Chart.
To show that, right? It's almost off the chart. Maybe, if I could get the mayor, that would be good. I'd like to show him that number too.
Yeah, very strong numbers.
Right, a lot of that came from contributions too.
Yeah. Well, contributions and performance,
returns,
exactly.
Right, that's 7.66.
Very good.
Net of fees is
That goes in
a little over 7%.
Very good.
So the 10-year number now for police is 7.66%, so it's higher than the 7. And as we add in more of these good positive numbers, hopefully that number will continue to go up.
The year's not over.
And the year's not over. That's right. So again, as I mentioned, as of November 26th, police is at $31.5 billion. So if there aren't any questions, I'll turn it back to Thad to take us out of public.
So we have nothing further. I'm sorry, we have one. Apologize. There is one other item, number 3, but I think there's a request.
I'd like to table that to review the material another month. And,
So we'll table that and bring that back in a future month.
be fine.
Thank you. So The Controller's Office has nothing further for today's public agenda. Is there any questions? Take a motion to move
Motion
in.
to go into executive session.
Second.
Second.
Great.